Hey, Joshua.Kittel here with Opus Advisors. In this video here today, I'm going to talk about FHA loans and credit scores and kind of how FHA looks at credit score. If you listen to a lot of the news and stuff, you'll hear all kinds of reports and stuff saying that basically it's very difficult for homeowners to purchase a home unless they have stellar credit. And FHA is a perfect example of a program that, what the news is saying just isn't correct. FHA is a great program. It's not exclusive to first-time homebuyers, and it's very lenient when it comes to credit and credit score. So we're just going to review a few key things today, and then the details are really important. So we'll give a quick overview. But if you have specific questions about your scenario, and if you're in Oregon or Washington, I'm licensed to lend in both those states. Feel free to reach out to me about your specific scenario. I'd be more than happy to have just kind of a quick, casual conversation and answer any questions you might have after watching this video. Okay, so the first thing is credit score. Now, a perfect credit score is 850, and the worst credit score you can get is about 350. So I would say most lenders would consider stellar credit to be that 700 or higher score. Your moderate credit is probably about 660 to 700, and then kind of, I don't know, maybe less than moderate would be 660 to about 620. And then below 620 gets into where it's kind of, credit challenged. Now, with that said, FHA doesn't have a specific credit score. It is possible with a score as low as 580 to get qualified for an FHA loan. But what we have to take a look at and consider is not just what the score is, but what is creating that score. So for example, it's possible to have a 680 credit score, and because of an item, particular item in the credit report, you wouldn't be eligible for an FHA loan, yet another borrower with a 620, much lower score, would be eligible. So let's talk a little bit about some of the main things that kind of go into credit scores and how FHA looks at it. So the first thing we'll talk about is what we call significant credit items. These are things like bankruptcies, foreclosures, short sales, and judgments. Now, the first few items we talked about, these are items that regardless of what your credit score is, you have to wait a certain specific waiting time from the time that event happens before you're eligible for the program. And this is true with all the programs, but with FHA, these waiting periods are the shortest compared to the other programs like you would find with conventional Fannie and Freddie loans. So the first one let's talk about is a Chapter 7 bankruptcy. Now, if you've had a Chapter 7 bankruptcy, the waiting period for an FHA loan is 2 years. And that's based on the date in which the bankruptcy was discharged. So not the day you filed for bankruptcy, but the date that it finished it. So if you look at your bankruptcy paperwork and you look at the date that's stamped on that, you can go 2 years out from that date, and from that point on, you'd be okay with an FHA loan, assuming your credit score is where it needs to be. Now, the other caveat, though, with FHA is after you've had a significant bankruptcy, you have to have reestablished good credit and not had any additional late payments after that. So if you had a bankruptcy and it's 4 years ago, and after the bankruptcy you got back into credit troubles and had a bunch of late payments again, even though you have an acceptable score, and even though you're more than 2 years out from that time frame, FHA will still have an issue with that particular case. Now, the other bankruptcy that is common is a Chapter 13. And a Chapter 13 is where you basically, your creditors and stuff get included in the 13. You enter into a court-designed repayment plan, but you're not writing the debt off. You are going to pay it back. You're just going to basically stop the interest that's accruing on those accounts. Those accounts get frozen. The court says, here's how much you're going to pay per month, and then you follow through with your program. Now, if that's the type of bankruptcy you're in, you're only required to be in that bankruptcy from 12 months from the date in which the bankruptcy was finalized. You need to show 12 months of on-time payment history. So if you've had 12 or more months of on-time payment history per the Chapter 13, then you are allowed to apply for an FHA loan. However, because you are still in a Chapter 13, the court will have to approve you purchasing a house and adding more debt to your profile. So it's not just that quick and easy. Now, if you've paid off the Chapter 13 and it's done, then there's no waiting period. If you enter into a Chapter 13 bankruptcy and for some reason you're not able to go through with it and you miss payments and it basically becomes dismissed and becomes like a Chapter 7, then at that point, from the day in which it was dismissed or discharged, you would have a 2-year waiting period from that point. So you may have been in Chapter 13 for a year, then couldn't keep up with it, it got discharged. You would have to use that discharge date, not the original date you went into it, to wait 2 years to move forward. All right, so the other big item that is quite common, especially after the market meltdown we had in 2008, is short sales and foreclosures. Now, these two items are looked at the exact same way with FHA, and they basically require that from the date in which the home was foreclosed, and that date is based on when the deed of the property transferred out of your name. And there can be a lot of confusions with foreclosures, especially because banks have made a huge mess of it, where people have thought that the bank had finalized a foreclosure and it actually didn't get finalized for maybe a year or two, or I've even seen 3 years later before it actually got finalized at the courthouse. And so again, what you want to do is find out when did the deed come out, removing you from the property, putting the lender back into the title of the property, and from that point, it is a 3-year waiting period. And the short sales done the same way. But instead of going when it goes back to the lender, it's the date in which you actually funded the loan, you sold the property, and then from that date, you need to wait 3 years. Now, it is possible to have a combination of these two things. So you might have gone into a bankruptcy, and as part of that bankruptcy, the house was included into it, and then it later got foreclosed upon. And if those two things happened at the same time, then the waiting period is going to be the greater of those two. So again, you may have finalized your bankruptcy on a certain date, but the foreclosure may not have finalized to maybe a year later. It's going to be a 3-year waiting period based on the foreclosure, not the bankruptcy. Okay. And the last little item too for credit that shows up for derogatory that people have a lot of question on are judgments. And for the most part, judgments do need to be paid off in full. However, FHA does say if you have a judgment and you've entered into a repayment plan with that person with the judgment, and you can show that you've made at least 3 months of on-time payments and you're just paying it as agreed at that point, then they can choose to basically not require that to be paid off prior to close. One exception to that would be child support and spousal support. If there's any past due child support or spousal, that does need to be paid current before you could fund on your loan. So the last little item I want to talk about with credit is maybe less with credit and more about debt, but it's really important because a lot of people have student loans, and FHA has recently changed how it looks at student loans. In the past, FHA has allowed that if your student loans were in deferment for more than 12 months, you could ignore that monthly payment. Then they modified it to where even if it's in deferment, you still had to account for a payment, but as lenders, we were allowed to take a look, and with most student loan, I'd say borrowers use what's called an income-based repayment plan. So depending on what their income is and their balance of their loans, they would adjust that payment. And so you might be making a significantly less than full payment because of the income base. FHA used to allow for that, and we could use that lower payment amount. But in 2016, they did modify that, not for the benefit to the borrower. And currently, as FHA rules stand today, if you're not in what's called a fully amortized loan, meaning that your payments, it's like a 30-year fixed rate loan, if your payment isn't such that it's designed to pay off that loan over that amortized period, then we have to use the greater of the actual payment or 1% of the outstanding balance. So for example, I had a client with $80,000 in student loans. Their monthly payment was $300 a month because it was based on their income. But going with FHA, we had to use $800 as a payment, even though they're only paying $300. So this is not one I'm a big fan of, but it is a change that we've seen both with like Fannie Mae on the conventional side and FHA. So that's just something that's really important to take a look at. Again, the other thing we want to look at in details when we're looking at scores is what your payment history is. And FHA, again, they are lenient with having some missed payments and stuff on items, but we always do have to take a look at how many missed items we've had and just the overall look of the credit. But I think in closing here, I'll just kind of leave it with this is, again, you don't have to have stellar credit. You can have items like bankruptcies and foreclosures in your past, and you can still qualify for a home. You can have less than stellar credit. You don't have to have a 700. You might have a 600 or a 620. You can still qualify. I will say that At 620 and above, underwriting is a little easier to get FHA system to approve the loan. And at 640 and above, it pretty much treats everything about the same. But you might have to have more restrictive loan limits if you get below the 640 and 620. But again, there's lots of little details, so if you've got more questions, please give me a call or shoot me an email. I'd be more than happy to talk to you about it, and I hope you found this video helpful and informative. All right, that's it for now. Thanks again.